Crypto volatility explodes as Trump's tariffs trigger a massive liquidation over the weekend, and Ethereum drops 30% plus. Bitcoin holds up better and recovers above 100K as Canada and Mexico get a 1-month delay. But nerves remain around a China retaliation, keeping front-end puts in a slight premium. All this and a whole lot more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran from Options Insight. I've got my man Dave in this brand new studio from FRNT. And today we've got a special panel discussion with some of the biggest players in the custody space. But before we get onto that, me and Dave are going to do our quick macro and vol roundup, and then we'll get onto the special episode. So, mate, serious volatility this weekend, huh?
Yeah, just a little bit, huh?
Yeah.
And it's funny because there's a time last week I thought we looked like we were going to break out to the upside.
You always think we're going to break out to the upside.
Yeah. No, but we were looking good, and we had the Fed, which was kind of a bit of a nothing.
It was a nothing done, yeah. We had good tech earnings. Well, we didn't have great tech earnings, but the big tech stocks actually traded quite well after earnings.
Yeah. And bear in mind, obviously, this time last week we were talking about DeepSeek and all that stuff.
Yeah.
So we recovered from that, as we, I think, suggested that we would.
Mm-hmm.
Fed was, we didn't really learn anything new, more of a hawkish statement, but then he kind of rode back on that a little bit. And essentially, data dependency, still feel, I think the Fed's still in a position that, we'll get back into this disinflationary path, but we're in no rush. I think that was the message to cut rates, but they're still going that way. So from a macro, we're still going into an easier rate environment. ECB cut rates, I think, for the 5th time, and we'll continue to cut rates. Bank of Canada cut rates, I think, for the 6th time, I want to say, for 25 bips. Interestingly as well, they ended their quantitative tightening. So they're actually even going to flip back to purchasing assets as part of their normal sort of balance sheet management. So it kind of still feeds into, from just big picture macro, feeds into this easier rate, easier liquidity environment, which I think will be still supportive for crypto and broader risk throughout the year. But then there's a guy in the White House called Donald Trump.
He had other plans.
He had other plans. I mean, look, I've been saying, and I still actually stick by this, I think we probably won't see like the fear around the tariffs and how harsh he's going to be around that. I still think in practice we won't kind of get anything too bad. But
well, we've seen it, right? I mean, the market was ignoring it until Friday.
Yeah.
Right? The market was like saying he's bluffing till Friday. Then suddenly he's like, no, the tariffs are coming this weekend.
Yeah.
And the market's suddenly like, oh, okay, starts selling off.
Yeah.
Then he implements pretty much the harshest version of the tariffs that he's been talking about in one shot at the weekend. Market completely craps itself. Yeah.
Yeah.
But it turns out that was just a negotiating ploy. Gets on the phone to Mexico and Canada, and they start doing what he wants. And it's like, okay, we'll push those tariffs a month. Maybe they're not going to happen now. Yeah. So now the market's seen what it already kind of believed, which is it's a negotiating ploy, but he's not afraid to basically, do them. And he doesn't seem to care if the market dumps a few percent, because he knows that the pain he's inflicting on other parties, on other countries, is probably too much for them to bear. So they are going to bend to his will a bit, basically. So that seems to be the art of the deal right now.
And look, Bitcoin's always got a knee jerk, as a risk asset. The
only thing open on a Sunday.
And it's the only thing open on a Sunday over a weekend that you can trade and kind of hedge against.
ETH got destroyed.
ETH got absolutely destroyed.
Why is that? Is there some big fund blowing up there?
There was chat around that. Don't know how sort of true that is. It definitely felt like someone.
Yeah, but the liquidations.
Get me out now.
We're talking 10 billion of liquidations or something. People
record like liquidations. Liquidations. So
more than FTX, more than Terra Luna, all of that, right?
So it's big. So which kind of surprised me, because I didn't think there was that much like leverage that built up in the system.
Yeah.
Okay. But look, I mean, ironically, like when I think of like what's going on, like, and the fact that, you know, you can have someone who's running the most powerful economy in the world, just at, you know, drop of a hat, you know, kind of almost tear up some of these trade agreements and whatnot. Like, for me, it kind of reinforces the like long-term bull case for Bitcoin in terms of having a decentralized, non-sovereign asset that isn't at the whim of these political leaders, right? But obviously, first thing first, you know, Bitcoin's just going to react with broader risk and be that risk proxy and got hit. I will say, like, I feel like we actually hung in pretty well.
Bitcoin did.
Bitcoin,
like the fact that it couldn't really break 93k for very long. It got down to 90. I had a cheeky bid in 92k and I got filled, which is quite nice. But yeah, I mean, I agree. It was very resilient on a relative basis to ETH, right?
Yeah. So again, I think that part as well, I think I've spoken about before. I think Bitcoin kind of like covers both sort of tails of the risk distribution in terms of it's obviously the big, you know, right tail risk on asset, the biggest risk on asset. But I think at the very sort of left tail when the world's blowing up, and particularly when we're questioning, you know, economic and political structures, which we kind of are, right? We're questioning like the world order, right? What are you going to own? Like, you kind of going to own gold or Bitcoin sort of thing. So I do think if you go to that left tail scenario, Bitcoin probably holds up. But the one thing I'll say, and obviously, like, he's going to say these things like dollar goes bid, risk gets hit, Bitcoin gets hit. Quite surprised how yields actually like were quite well anchored throughout all of that. But I think, again, the global growth concerns are perhaps outweighing the inflationary elements of tariffs.
Yields didn't really go very far, did they?
No, and maybe there's a safe haven element in that, and then maybe it's actually growth's probably going to be impacted more than inflation. And I'm still, we've had this conversation before, but I don't think tariffs are probably as inflationary as people think. I mean, for a start, dollar goes bid and it offsets a chunk of it.
I've got a question. So in the past, you've mentioned the TGA drawdown as one of the reasons why you're quite bullish for Q1, right? But the TGA popped at the weekend, I believe, or recently. It's popped quite a bit. And like the DOGE, the whole DOGE thing and how they're trying to basically stop spending and all that. Is there some impact that's going to have on the TGA and the way it's kind of drawn down and the way that money kind of enters the system?
Yeah, well, you've got the RRP as well, right? So you got the reserve repo.
Yeah, I forget about that one.
Cash that money at banks essentially, and you know, will park with the Fed overnight. And then you got the TGA, which is the Treasury's essentially cash account that they hold at the Fed.
Yeah.
Like, and actually as well, don't forget we were in month end on Friday.
Oh yeah, that's true. We were. It always pops on month end.
Okay. Particularly when you have banks window dress.
But is the kind of DOGE plan likely to have some impact on that dynamic?
No, because I don't think it's going to touch the sides. Like,
okay.
I think they're going to cut some wasteful spending. Like, every government should be doing it, and it's going to be great. But you know, the two biggest like line items are social security benefits and interest expense, right? So that's like DOGE isn't going to touch the side, so it's really not going to make a huge amount of difference.
Fair enough.
In terms of like the debt dynamic, and we're still, you know, we're still at that debt ceiling, so they're not able to raise any new, you know, net new debt. So they're going to have to pay their bills, and it's going to come from the TGA drawdown. So we still going to have this positive liquidity flow in. So I think from the macro, not a lot's changed. Obviously, strapping for some volatility. But I think the final thing I will say on Trump, and having sort of traded through his last 4 years when he was in power, the mistake everyone makes with Trump is thinking that it's all just random chaos.
Because it comes across that way.
It comes across that way. But actually, this is a guy who very much knows what he's trying to achieve and knows how he wants to go about it. Now, I'll probably get hate for saying that, right? Because it's easier just to dislike the guy and think it is random chaos. But it's not. And I think from a trading point of view, right, when you can accept that and then start thinking about, okay, what's his goal here?
What's his angle?
Because he's not just randomly coming out with this stuff. He knows what he's playing at. And I think you'll find it a lot easier trading the next 4 years to keep that in mind. This isn't random acts of chaos. This is a guy who has a you know, goals that he's trying to achieve. And ultimately, with that in mind, he wants a weaker dollar to help address trade imbalances. He wants stocks higher. He wants yields lower, stocks higher, and he now wants Bitcoin higher. So you kind of have to navigate this path to go, okay, whatever he's doing is probably a means to an end to get there. And I almost took from when he's talking about the US, consumer, I guess, in terms of we might have to experience some short-term pain. I almost thought that was a nod to markets as well. Like there might be some short-term pain, and it turned out it was very short-term.
Yeah.
What does it mean on the vol side? Because this must be great for the.
Oh my God, it was pretty spectacular, right? What happened this weekend? So, I mean, Bitcoin vol wasn't that exciting, right? So, realized vol popped about 10 points from like mid 40s to mid 50s. The front end did move on Bitcoin, but we're talking pretty controllable. Week on week, it was only up like 5 vols or something like that. But ETH is the one that really took off. So, front end ETH went to something crazy like above 100 vols. Realized vol went from 70 to 120 on ETH. So I think from like some point on Friday, Saturday to the low, ETH was down over 30%, right?
Yeah.
Which is an enormous vol move, right? So, but as usual, we had our liquidations, we bounced, and the vol started fading really quickly. Vol sellers come back in. Skew got a bit spicy. I think Bitcoin skew got to about 4 vols for puts in the front end, and ETH got to about 10. But already that's all mean reverting back again as, when Trump's son's coming out and saying buy ETH, what do you think ETH's going to do, right? So obviously ETH's back into the kind of high 2000s. It does look like 3,000 to 3,200 is going to be a bit of resistance on ETH. But in general, vol trickling its way back lower. Long-term skew still very much for calls, but all the weakness concentrated on the front end. So people are still willing to pay a little bit of premium for puts just in case this thing's not fully done yet. But yeah, it's kind of a buy the dip market, right? The options market has clearly been saying buy the dip whenever we get a dip, because it's saying medium-term skew is not budging for calls. It's always in like 5 vol call premium. And it's just the front end that catches this put bid. And that's very fickle, and that evaporates very quickly. And we've kind of seen we've seen the same dynamic again. In terms of flows, we saw some call spreads. We saw some dumping of calls initially as we were coming off. So like March calls getting dumped, June calls getting rolled down. But then as we started to base out and Bitcoin was trading, like say Bitcoin was quite resilient, then short end call buyers came in to try and play that pop basically. So that was generally the summary that I saw in option space.
Interesting times.
All right, let's move on. That's me and Dave done. Let's move on to our special panel discussion. All right, so I think that's about enough out of us two, and it's time to go on to our panel discussion. So we've got our esteemed guests, also known as the Custody Titans, as we've been putting out on Twitter. So guys, why don't you introduce yourselves and tell us a bit about what you do?
Adam Groom, work for Copper as European Head of Sales. Copper is a custodian, first and foremost, but we've also expanded into sort of prime services and collateral management. Our flagship product is Clearloop, which is the leading off-exchange settlement network within the digital asset ecosystem. And we also have an agency lending product. So not our balance sheet, but we work with long inventory providers to lend into our ecosystem.
Hi, Brett Reeves. I work at BitGo and I head up European sales and our Go network. BitGo is, I guess, best known for being a custodian and a hot wallet provider. We've been around for the last decade in the crypto space, which is obviously an incredible amount of time, and a lot has kind of transitioned through BitGo in that time. In recent times, we've set up more of a trading desk. So we've got an electronic trading platform for our custody clients to trade out of. An OTC desk for obviously the bigger tickets, more liquid size, and a financing desk as well. So trying to be that kind of all-rounded custodian to provide a one-stop shop to clients.
And I'm Sophie Bowler. I'm the Global Chief Compliance Officer for Zodia Custody. So not in sales, coming with a bit of a different lens here. So I'm responsible for developing and implementing the compliance control framework for Zodia and looking at regulatory and licenses. Zodia Custody, as a bit of background, was born out of Standard Chartered in 2019, 2020. So we're a Standard Chartered venture, still majority owned by Standard Charter. And I think the big thing for us is trying to bridge the gap between traditional finance and custody. So offering the bank grade custody solution with controls, but with the nimbleness of a fintech. And I think the core focus for us is, of course, core custodian. That is our reason for being and our bread and butter. But in addition to that, we've got Zodia Interchange, which is the off-exchange settlement solution. We've got Zodia Gateway, which is enabling our clients to connect to the broader digital asset ecosystem from the safety of their wallets, for staking, prime brokerage, various other services, and then enterprise as well, which is essentially enabling other institutions to utilize Zodia's technology for their own custody purposes as well, so that they can be their own custodians. So, yeah.
Great. Well, thanks for coming on, everyone. Custody is not something I ever really thought about much, right? Obviously, I'm a retail crypto trader. And a lot of the reason why a lot of retail people are in the space is because of the whole, my self-custody, right? I want to hold my own keys, not my coins, that sort of thing. So I guess the first question is, why has custody become such a big thing, right? And what role does it play? And is it all about this institutional adoption? Is that the reason why, people like yourselves are doing so well and there's so much business out there for you? You want to start there?
Yeah, I think for me, when I think of custody, if we look at the broader digital asset ecosystem, it is that fundamental foundation. So it's that trust and the safety and security of the private keys and ultimately assets. I think when we think about crypto and the adoption, whether it's retail, like people like yourselves and ourselves, or institutions, we want to make sure that our assets are ultimately safe. And I think if we don't have that comfort and we're not sure that they actually are, it's going to impact the broader adoption and the increase and thriving of the crypto ecosystem. So for me, custody is that foundation, and that's what we have to get right. And then it will increase in the institutional adoption and the retail adoption as well. So I think that's why it's just so important.
But obviously exchanges also offer custody, right? So is it a case of after the FTX blow up, people just lost trust in that side of things?
Yeah, I think there is an element of now people are thinking twice. There's that concentration risk. If I'm trading with an exchange and I've also got my assets safe kept there, if there is an issue, if there's an insolvency, if there's a hack on that exchange, then there's a huge risk to all of my assets. I do think people now, just retail and institutions are wanting to diversify their risk and actually get a custodian that is actually a core custodian, that is their bread and butter, versus, I guess, putting all of their assets in an exchange. So I do think since FTX, there's been that move away and then looking for regulated custodians now.
Yeah, I think we found, we've been regulated since 2016 as a qualified custodian in the US. And I think initially we found a set of institutions that wanted, as much as, yes, you can hold your keys. If you go into like miners and entities like that, they're holding millions or billions of dollars of assets, and they don't necessarily want to actually hold those keys. They want to put that to a third-party custodian that actually secures their assets, much like you do in traditional finance. When and to the exchange point, you don't trade on the CME and leave your assets on the CME. They're typically cleared through a clearinghouse and settled somewhere else. So on that institutional side, yes, definitely. On the retail side, I think there's still a bit of a balance. I mean, you've got people that might use ledgers. You've got some people that still just leave the assets on exchanges. And I think that's still kind of being figured out where people want to actually go and do that.
Is there an evolving retail offering that people like yourselves are offering people like us who, I don't have anywhere near as much crypto to even think about that, right?
Yeah.
He's being modest.
We launched the product probably 6 weeks or so ago for retail, but it's not a product that's going to compete with exchanges or anything like that. It's very much for kind of retail clients that might want to buy and hold. We're the distribution agent for the FTX estate. And we saw that there was a number of clients that are going to get dollars distributed to them. They want to come back into crypto, but they're pretty nervous. They lost all their money on FTX, right? So they're kind of getting a second chance. And so there's an opportunity for that market to kind of exist. It's not going to be for everybody. It's not going to be necessarily for yourself. You're wanting to actively trade on exchanges. Mm-hmm. That's a different type of product that you're after. And I'm not sure that that's quite there yet. But I think the landscape's changing.
Yeah, I think you have to look at the use case and what you're serving for your particular client set. So Copper are institutional only, and the predominant amount of our book is hedge funds and trading firms. So hedge funds, the minute they take outside capital, that kind of means that they can't utilize self-custody. I speak to some of the largest due diligence providers in the world, people like Auburn Partners, and they don't see self-custody as something they can advise their investors on. So, the minute you step into that institutional space, you just require different products and services. I would say our focus for the hedge funds and trading firms we work with is not just the custody, but it's the collateral efficiency. And that's kind of where Clearloop and other off-exchange networks have developed, and that's other problems they're trying to solve, because crypto's unique in the fact that it's a bearer instrument and you have to pre-fund exchanges. But the minute you do that, it's very capital inefficient. So, we're always looking for ways to kind of sweat that collateral, make sure, assets can move around an ecosystem, more freely, which I think is important and what we see a lot of use out of our client sets from.
Yeah, I mean, the interaction between the custodians and exchanges, right, is obviously growing in terms of the integration and the complexity, I guess, of that. I mean, it's interesting with you guys at Copper, Adam, because like pre-FTX, I think a lot of us in the space knew a lot about Clearloop and kind of providing that off-exchange custody, but still being able to integrate and manage margin and stuff like that. Interesting, how's that kind of evolved from pre-FTX to post-FTX?
Yeah, no, look, it's been a journey to be quite honest. So I joined Copper in 2022, early 2022. My previous career was prime brokerage at Merrill Lynch and Bank of America. So coming from the traditional space, servicing large hedge funds, proprietary trading firms, and you can see as we talked about earlier, you need that separation of church and state. You can't have an exchange be the de facto lender, clearer, custodian, etc., providing all of these services. So when I joined Copper, I joined with a team of 6 people that were essentially all prime brokerage people, and we set about looking at the products and services that we had, and that included like a product manager from prime brokerage, a risk manager from prime brokerage. I was more on the relationship sales side. So we had all the different aspects of what you wanted to look at, and we set about redesigning Clearloop at that point. So technically, Clearloop was always a great solution. Deribit were the first exchange to integrate. But as we went through that 2022 market dislocation, particularly around, I can't remember now which went first, but it was probably Terra Luna, then Celsius, then Three Arrows, and then everything cascaded after that. Mm. So when we went through the first dislocation, one of our exchanges became insolvent. So it's CoinFlex, you maybe remember this if you've traded in the market for a little while. So our risk manager picked up that there was negative news on CoinFlex in the market, who'd be data scraping everything. He then went through the collateral that we were holding on behalf of our clients and CoinFlex, realised we were over collateralised, which is a good place to be at that point. Spoke to CoinFlex, established they were in fact insolvent, advised our clients to, exit all of their trading, which they did. And then we returned our over collateral stub to CoinFlex, and, they became sort of no longer, so to speak. But what that did, it really sort of sharpened our pencil, if you like. So, when you work in a bank, the minute there's a default scenario, the first thing you do is get the risk manager, you get the lawyers, and you look at the docs, you look at what your rights are. And so we went through that process and we realised this product's great, but we probably need to make it even better. So then we went through a phase of redesigning Clearloop from that kind of June 2022 period. So we changed it into an English law trust structure. So it became insolvency remote to Copper and to the exchange. We put a risk methodology in with all of the exchanges where we call the exchanges for collateral, and we monitor that 24/7, 365. And so we built that, and then FTX happened, which, blessing and a curse. It wasn't a good scenario. People lost money, awful fraud. But we were positioned well for that kind of uptick when off-exchange settlements solutions really became, dominant in every conversation, particularly in the institutional space. So we were then able, with client demand, to then go from 3 exchanges to 9 exchanges in a 2023, early 24 period. So yeah, it's been a phenomenal change, and Brett at BitGo will give us the. He's having that same experience. The guys at Zodia are doing it, Kamena are doing it. Everyone's looking for, their solution. But it is difficult because, like any business, there's a lot of resource constraints, and you kind of have to pick your battles and figure out which fights you want to fight in terms of getting stuff done.
And BitGo and Copper have collaborated. Is this right?
Yeah, it's
Why? What does that look like, and why?
Not exclusive.
yeah. So look, it was announced just over a year ago that there was a collaboration between both firms. I think Clearloop, as Adam has explained, has been, I guess, the longest running off exchange solution. And in the US, we're a qualified custodian, and a lot of the funds and asset managers that we're talking about are obligated to use a qualified custodian under US regulatory rules. So it kind of made sense as a partnership to be able to try and work together and try and access their market as crypto kind of came out of winter. And so, yeah, that's kind of where we are at the moment. The docs are literally being signed as we speak, I think today. So that's positive. And then, we're making a push to go into that. And I think, the market being where it is good timing. But it is really putting, BitGo's kind of qualified custody solution together with the leading off-exchange solution to try and access traditional entrants into the market.
And I think that the other thing in our thinking of doing the partnership is, again, going back to sort of traditional finance in our days at prime brokerage, the lessons we learned from 2008 was pre-2008, there wasn't, most hedge funds had 1 PB or a prop shop had 1 PB. Now the largest have 8. If you launch a hedge fund, you probably launch with a minimum of 2. And it really gives the market the optionality to decide where they want their collateral to sit and to split the book and really manage counterparty risk in that way. So, it's kind of separating custody and Clearloop and just allowing that network to grow.
It's like creating robustness in the system, basically.
Yeah.
Right?
It's funny, in crypto, I still find there's still a lot of competition, whereas in TradFi, JP Morgan trades with Citibank or Morgan Stanley, and JP Morgan use Standard Chartered for sub-custody in Asia and things like this. So, as much as people are competitors, they still have to work with each other. And I don't think crypto's quite at that place yet. I think, you see a lot of announcements about partnerships and things like that, but I don't think there's actual true collaboration between companies that are kind of competing. And, it was before my time at BitGo, but I think, hats off to the Copper team and the BitGo guys that decided to try and push forward with this solution.
Yeah, interesting. And something for you, Soph, as well. Obviously, slightly different angle to this for you, coming from like head of risk and compliance. Obviously, we've got Mr. Trump in at the White House. That situation, from a regulatory point of view, looks to be changing very quickly. You've got MiCA. Who knows where we're at with here in the UK. Where's your kind of focus from a risk and compliance point of view right now? What are the kind of hot topics? Mm-hmm. And also, how do you kind of provide a kind of global custody offering that keeps up with these, which is quite still a fragmented regulatory environment?
Yeah, no, it's an interesting one. And I think that point is where a lot of my focus is at the moment, because as you've just said, there's so many different regulatory regimes that are coming out. They're coming out all at different times. They're coming out with different requirements. Regulators, when you talk to them, they do definitely want sort of different things. So I think a big challenge and a core focus area of mine is working with all the different compliance officers across the countries to, first of all, obtain the licenses to even just continue on business, because we want to continue to provide custody, but then also thinking ahead of like what's the next thing. So I think that's one area where there's quite a lot of focus and challenge. Is we've got the licensing regimes that are coming out now, but they're just solving like the immediate first problem at the moment, and they're not thinking next. So for example, custody of tokenized securities, like tokenization is a big topic at the moment, but it's not quite yet in all cases been thought about from the different legislators. So I think that's just something that really is a focus area, and it's sort of like we don't quite have the answers yet. So we're sort of waiting for that to happen. I think another area that's probably big on heads of compliance and heads of risk is crypto is just changing so quickly and so rapidly. It's just innovating so much. And so it's way ahead of like all of the legislation, but also the risks. We spoke about DeFi earlier. That hasn't even been really touched or sort of thought about from a regulator's perspective or from a risk perspective. So constantly trying to stay ahead of like the new scams, the new attempted frauds, the new risks that we see on the blockchain. and trying to enhance controls around it, because, as was mentioned, particularly institutional clients, their expectations have massively increased now in what they expect the custodians to be doing. And their clients have got a big focus on which custodian you are actually using. So there's a lot that we have to evidence in terms of all of those controls. So it keeps us busy, but I think it's for the good. Like it's sort of helping everything to move forward.
Do you feel as well? Is there a good two-way conversation with the regulator? Has that evolved as well? Is there more engagement?
Yeah, I would definitely say there's been an uptick in engagement for sure. I think before, the regulators and the legislators, the regulators wait for the governments to bring out the legislation. And I think for a time, the regulators didn't really have any guidance and steer themselves. So they didn't really have any of the answers. And this is all quite a new space for them. So that's definitely improved. That's definitely increased as they've got more and more clarity. And that's helping us. But I think there's still, as I said, crypto moves much quicker than the legislators do. So there's still those areas that we don't have clarity on yet. In the UK, we're still waiting on the digital asset regime to come out. Europe's been a bit further ahead. Maybe Trump will announce that there's a regulatory roadmap there. That's what everyone's been shouting about for ages in the US. So it's definitely improving, but I think it'd be great if it was a bit faster because then it would just make our lives a bit easier, just give us much more clarity. And we know what we're doing then. I think we're in sometimes a bit of a grey area where we're waiting for things to happen. But it'll come. It's coming.
Yeah, interesting stuff. Going back to the exchanges and this kind of interaction between custodians and exchanges, and obviously with Deribit, how different is it in terms of thinking about the interaction with derivative-based exchanges versus just a pure spot? The spot, particularly when it's buy and hold, seems an obvious, easier kind of interaction. But what are the challenges and how does it differ when we're talking about derivatives and the collateral that's kept off exchange for that?
Yeah, look, I think you make a good point because, and this is probably why the market of custodians is big enough to service the entire sort of growth in the crypto market, because each different use case requires something different. So, for example, if you just want to buy Bitcoin and cold store it and hide it in a vault in a mountain in Switzerland, there's options out there to do that. But if you're a trading firm or a hedge fund and you have to transact quickly, that's not really going to work. I think one of the things that we see, particularly in Clearloop, is it's mostly derivatives that's used via Copper and via Clearloop. I think we at its peak secured about 7 billion of initial margin across all 9 exchanges, and that is predominantly all used for derivatives. So what you have to think about there is, what are you trying to support? And one of the challenges that we've had is, what do our clients want to trade, and what can we keep up with supporting? And I think across all of the exchanges, we quickly realised you just can't chase the long tail of every single asset. So we have this concept of settlement currencies, and it's really the collateral that's used to support derivatives trading. So USDT, USDC, BTC, ETH. So that's the predominant bulk of what we're seeing as collateral used. Now, the next phase of that is really yield-bearing collateral. And we're working with all of the stablecoin issuers that are bringing those products to market.
It's like Hashnote, right?
Yeah, and Deribit have been a leader in that space, and other exchanges are following suit. Now, I think Hashnote's quite unique, and what these issuers need to do is they need to work with the exchanges and work closely to sort of build the universe of pairs, because USDT is in this amazing position where everything's listed versus USDT. So, if you're trading and using that and you're getting liquidity for trading all of these different pairs, 4% is nice, but 4% is no good if there's no trading pairs listed versus the stablecoin that's going to give you 4%. So it's a little bit chicken and egg. And I think that the evolution of that is probably going to be, things like Biddle, things like Franklin Templeton's Benji, which are actually securities. And again, we're working with you guys, we're working with other exchanges to use our Copper Securities UAE entity, which is a licensed fixed income and equities broker dealer out of Abu Dhabi, because that can hold like actual securities that are yield bearing, and then we work with the exchanges to recognize it as collateral on the exchange. So, as Sophie said, it's so fast paced. You need regulators that are going to keep up with you. Like, we're regulated in Switzerland. We're in the UK now. I've been in the UK all my life, but like, the FCA don't have a framework to kind of regulate copper and clear loop. So we go for Switzerland, and they've got a framework that really understand it. And it's going to be a case, and you'll see this closest, and you can give us more insight. But each regulatory regime has got to keep up, and it's very difficult in this space.
Switzerland itself, I mean, you can pay your local taxes in the different cantons in crypto. It's so far removed from where the UK specifically is, but many other countries as well. So, it is a breath of fresh air when you go there, because at least they've kind of embraced it, and you have some direction to go on. Obviously, the US has been the outlier. That's obviously probably going to change rapidly. But similar to Zodia guys, we've got 7 different regulated entities across the world, because you need to try and service these different client types. But they're all going at different paces. They've all got slightly different rules. Even MiCA itself is not just a governing rule for all of Europe. Each country can still implement its own little kind of nuances within that regulation. So it's difficult. It's not the sexy side of crypto, but at the end of the day, it needs to be done, and people want to be able to look after those assets.
I also think the evolution of the yield-bearing stablecoins and the securities, which is really more important, is once they become integrated into the ecosystem, you bring in that next phase of clients that can essentially trade on an exchange but hold collateral in a security and don't necessarily need to touch digital assets. Now, if you're talking about the core belief in what digital assets are and what crypto are and long-term hold, that goes against that. But there's people that are going to long-term hold projects or coins or whatever that may be, and there's people that want to trade it. And quite frankly, the more capital that comes in, the better. I mean, that's capital markets 101.
So what kind of collateral are we talking? Like, are we talking about tokenized government bonds, things like that?
Yeah, I think so. Like, if you look at the USYC, you look at BIDL, you look at Benji, that's a security. So you can have a large hedge fund come in, hold a security in a bank that's regulated to hold that security, and they can trade on an exchange, and they can trade the vol, they can trade the asset class, they can enjoy all of the liquidity and everything that exists within that asset class, but they don't necessarily have to touch digital assets. Now, we all want people to come in and hold digital assets and sort of, build the ecosystem. But again, the more people that are in the system, the better.
And you talked earlier about collateral efficiency, like management of collateral. I'm sure that's very relevant for options trading, right? So you mentioned derivatives being the bulk of what the hedge funds do. I'm sure some of that's futures and some of that's options. Yeah. How do you manage like the real-time sort of dynamic of options positions where the risk on an options position can grow or shrink very quickly based on market moves?
Yeah.
So the kind of margin that needs to be posted against that can go up quite quickly. So how do you kind of cope with that?
So we don't act as the calculation agent. So all of our clients still interact with the exchanges in the same way they would do without Copper and without Clearloop. Okay. And the margin calculation is done by the exchange. And unless it's wildly out of sort of market pricing, we will always accept that. If there's dispute rights between a client and the exchange, that remains between the client and the exchange. But we have the ability to step in, and that's part of the documentation that governs Clearloop.
How frequently does the margin get settled with the exchange?
Depends per exchange.
Right. Okay.
So, for Deribit, it's daily. For OKX, it's every 4 hours. For Bybit, it's every 2 hours. And again, the amount of collateral you need to, so the amount of collateral an exchange needs to post into Copper, that can be determined by how frequent the settlement cycle runs. So, the shorter the settlement cycle, the less need for a buffer, if that makes sense.
Yeah, interesting. I mean, the collateral thing is, like, obviously we had Leo on from Hashnote a few weeks ago, and talking about that, the different types of collateral that look and feel like TradFi collateral as being like just a really important gateway to opening up this whole space to allow those guys sort of coming in. Are you, and I guess one for all of you, but are you having more and more conversations with traditional businesses knocking on the door, looking to come in? Is that something that you're seeing? And is the collateral piece like a big part of that as well? Or how are you seeing that?
Yeah, I think, we're seeing some of the very, very big asset managers looking at the space. I wouldn't say they're necessarily at the point of looking at collateral efficiency. They're still kind of dipping their toe in and understanding exactly whether it's how to connect to exchanges or how to move assets around. And these are household names, and I think they're still exploring that side of it. But the collateral efficiency is clearly going to come. And I think these tokenized assets are a key to unlocking that part of the market. They're not just going to come in and dump and hold BTC there or some US dollar cash. They're looking for efficiency just as they do in TradFi markets. So they're going to, I think as that comes in, you're going to see crypto markets try and become much more efficient than they currently are. I think speaking to you guys earlier, there's a bit of a disconnect with kind of how efficient some of the markets are in terms of whether it's moving from exchange, some of the basis trades that you can see and the different opportunities. I think those will start to narrow a little bit as these participants come into the space.
Yeah, something we've noticed, like just through our conversations over the last year with all the guests, it's just like the general theme and message seems to be that it's still early, right? In terms of the institutional adoption, right? All these frameworks that are being put in place and all these products and services that are being offered to these big money, real money managers so that they can enter the space. It's still the beginning of that, right?
Yeah, absolutely. I mean, I would say since November and the US elections, the reactivation of discussions, and I've spoke to counterparts across the market in similar seats, and it's a common theme. It's not just us, but that reactivation of discussions is just been phenomenal. Like, we've taken meetings with groups that you just wouldn't associate with looking at digital assets, and when we've sat down with them, the first thing they want to look at is meme coins or something like that. Which when you talk through what they actually want to do, they don't really want to do that. But yeah, it's that reactivation. I think again, going back to 2022, I moved across at a time when back through COVID 2020, 2021 at the bank, that's when not just all the proprietary trading firms we supported, but the hedge funds started to ask questions. Can you support this? Previously, some of the largest prop firms in the world that we serviced back in 2016 were asking the question, but, we just point blank couldn't service it. In 2020 and 2021, we were actually tasked to go and look at a solution. And so moved into crypto and thought, oh, great, all these clients are just going to come across, and FTX happened. And it was just like the phone went dead. You'd speak to people. And it comes down to reputation, investor appetite. If you're talking about a multi-billion-dollar hedge fund that wants to, for want of a better word, experiment in digital assets, they're not going to risk upsetting all of their sort of traditional investors for that kind of small bit of alpha. And I think we're starting to see that change again. You've always got like the crypto degens at these firms that are sort of banging the drum for it, but it needs to go past the investment committees and all of those groups.
But I guess it becomes a lot easier to get it past the investment committee when the US is talking about a strategic Bitcoin reserve, right?
100%.
When BlackRock is advertising that Bitcoin is a hedge against your government, I mean, it's just the narrative has just changed overnight. Probably back in November, right?
Yeah.
The ETFs changed a lot of it at the start of last year, but that's a specific advert I was referring to. But yeah, they've all come out and done it, and I think the ETFs changed everything. The election changed it even further, and it's wrong as well, just to point out that it's just asset managers. It's the mainstream banks, the investment banks are looking at this. We're all familiar with some of the names, but their trading desks are actively pushing into this now and spinning up those desks that have probably been sitting on the sidelines for a couple of years. Yeah,
I mean, I've spoke about before on this show, like even with FR&T Financial, my day job, and what we're building. We've built our business for for this moment, really, and for all the institutions to come in and providing those investment banking services into the space. And the thing that's really changed for me, and I've said this a couple of times, is pre-Trump, essentially, we were engaging institutions where they would they started to get the idea of Bitcoin and crypto and even those that were actually into it, and some would say, yeah, I'll hold Bitcoin myself and all this stuff. The career risk was just too high to start moving their businesses into it without the regulatory sort of certainty or certainly the support of that sort of regulatory regime. Now the career risk feels like it's flipped. That the career risk is not having a digital asset strategy, not starting to position your business into this space. And so we've certainly seen a pickup in it. And I'm sure you guys are seeing that, right?
Yeah, a massive uptick, and there's a lot more conversations. There's conversations around custody of tokenized securities, commodities, all those types of things. But I do think, to the point you've just made there, that there's still some. It has started to flip now, like that we have to get into it. But I do feel like some traditional financial institutions don't necessarily have the internal expertise and skills to know actually what to do and how to do it. And I feel like that sometimes is a bit of a barrier. And as you said, the regulatory regimes are not quite there yet. So they want to do it and they want to dip their toe in, but there's still that bit of nervousness. And a lot of the conversations we have is actually trying to sort of coach and guide them through as well as to actually how it can be done. How can we implement the controls to monitor on the blockchain? There's a lot of concern around, well, isn't there loads of crime on the blockchain and all this types of things? The typical stuff you hear. But actually, there's ways and means of doing that, and there's plenty of crime with like fiat currency as well. I think that's a lot of the conversation we have, but it's getting there for sure.
Do you have as well, like with you guys at Zodia, obviously the parent bank, the Standard Chartered? Is there a lot of interaction between, say you being head of risk and compliance there, and with like the risk and compliance on the actual banking side? Is that a
significant? Yeah. So we're owned by Standard Chartered Ventures, and then ultimately owned by Standard Chartered PLC. But it's almost daily interaction between the sort of compliance officers there and the risk officers. And one really, there's so many benefits, of course, but really good benefits is sort of support, guidance, help, advice we can seek from Standard Chartered at all times, and we leverage that a lot. So they're really supportive, like in that regard.
Do they get annoyed that you're able to wear trainers to meetings and they're not? Is that?
To be honest, we're still. Yeah, we're pretty professional in Zodia. Actually, it's funny. No, to be fair, like Standard Chartered are. They're moving into the crypto space as well, and they're like custodying in the UAE now, utilizing Zodia. They're setting up and diversifying into other different crypto products. So, they're a really good example of a firm that's trying to embrace it like a traditional finance firm. So I think they're going down that sort of route.
Does that not start to tread on your toes? Similar businesses or?
Yeah, no, there's definitely a careful balance.
Yeah.
I think where we've landed on that is it's fundamentally in the main a bit of a different client base. So it's Standard Chartered will be servicing its clients that it has sort of provides other services for that Zodia would not typically be servicing. So and for example, there may be quite a lot more of crypto native type firms that wouldn't typically go to Standard Chartered and they'd come to us. So luckily it's been okay. But of course, we are going to be providing the same services in the same markets. So it's
interesting.
Be careful with that. Yeah.
And one of like talking about sort of TradFi institutions, like I think Adam, you mentioned earlier about like managing collateral across exchanges and the efficiency. Are we yet at a point starting to think about crypto and non-crypto exchanges and thinking about that, or is that just probably the next stage of evolution, so that those that are going to trade across traditional exchanges plus crypto, particularly when we start talking about more traditional collateral and wanting to get the efficiency out of that?
I think, what you're getting at there is like how far are you from that nirvana of cross margin? Ultimately, if you're, if you're a traditional hedge fund, proprietary trading firm trading, multiple asset classes, there's efficiency gains. A lot of the multi-strats internalize first before they even like spray their books out to the various different financing desks. So, and then when they're at the various PBs, they expect internalization and offset there. So, I think we're a little bit from that, but that's definitely, the direction of travel.
Do you see, obviously, apparently the era of IPOs and buyouts and mergers? Does it make sense for a TradFi exchange to be buying a crypto exchange?
Probably.
Yeah. I don't see how they gain market share quick enough, right? They're just like the banks in a way. They're too slow moving, kind of oil tankers. How do they build out a perpetuals business or a crypto options business? It's going to be a journey for them. So it kind of, I don't know. Are they able to do due diligence on these guys and have a look? And is that an option?
Yeah, I think you're right, but the regulatory landscape probably needs to be clearer, doesn't it? Right.
Yeah.
Now that we just got Trump coming in, got that big meeting with David Sachs tonight. In fact.
Yeah. See what happens.
See what he announces. But yeah, once the clarity's there, then yeah, you're right. Probably an M&A cycle makes sense.
Yeah.
And look, I mean, all three of us are sitting here, right, working for crypto native firms essentially. And we'll be honest, if a multi-billion-dollar multi-strat or proprietary trading firm comes into the market, they're probably going to always prefer to face like a Boney, Standard Chartered, Goldman Sachs, JP Morgan, whoever that may be. So, that's just facts of life. Like no one can sit here and deny that. So, yeah, as Brett says, there's probably going to be, M&A activity and other stuff. I mean, but I think, all firms that operate and have been operating for some time, you've learned a lot of lessons. There's a lot of technology there. It's not easy to catch up. So it probably makes sense to buy rather than build.
Yeah, and I guess like almost to push back against that point, like you've kind of tied it back to that. Like for me personally, like I kind of and working in this space and having worked in TradFi as well, the complexity like in this space, in a weird way, I'd have more comfort with an established crypto native custodian than a new guy coming into the space who, yes, you were massive in TradFi and you might have a big balance sheet, but actually, like, how specialist are you in this space? I think that's it's not clear to me.
It's a good point, right? Especially as you come into the different types of tokens and chains and things like that. I mean, I think we're supporting 1,200 coins across 45 different chains. I mean, but that's 10 years in the space. It's not been done overnight. And there's a cycle that we can get to now where we develop the new chains and work with them. But yeah, there's a skill and there's a knowledge base that's been built up, as you said, and a new entrant to the space. Okay, maybe they'll do BTC and ETH, but how quickly can they then develop further down the chain? And I think you were saying, some of these TradFi entrants are testing out some strange coins, and they need the access point to that. So it's going to be an interesting dynamic how they set up.
Yeah, look, again, it comes down to people. If your job is to be, an equities long short PM, that doesn't necessarily mean that's what you do on your free time. So, there's an age and demographic thing that comes into play where people are growing up, learning sort of with crypto, like, investing, perhaps on a wallet on their phone or something like that. And then they're going into the workspace. So they're bringing that knowledge through. And but fitting that into an institutional wrapper is probably more challenging. But, there's some great firms out there that are doing it. And, I'm sure they spend a lot of time with their risk committees going through all of these things.
All right, guys.
Interesting stuff.
I think we're going to have to wrap up as we are running out of time. But I just want to thank everyone for coming on. This is the first panel that we've done, but really appreciate you guys coming. And hope everyone enjoyed that discussion. Watch this space. There's going to be plenty more panels in the future. We'll catch you all next week. Thanks.
Cheers, guys. Thank you.
Thanks.
Cheers.
Thanks.
Thank you.